All right, it's now about 6:35. I suspect we should probably get started now. We've got some attendees. Welcome, everyone. I'm Ashani Couchman. I'm the chair of the Younger Fellows for South Australia. And it's very exciting to introduce our first webinar in our series in preparation for practice. And today's topic is on the opportunities and pitfalls of starting a private practice. I would like to acknowledge the traditional owners of the land on which we are meeting, the Kaurna people, and pay my respects to elders past and present. Kia ora tēnā koutou, tēnā koutou, tēnā koutou katoa. Right, it's my pleasure to introduce Adam. And Adam is the Barton's director. And we'll be hosting our webinar today, and he'll be introducing a couple of other speakers as well. And we look forward to hearing what he has to share with us. Welcome, Adam. Thank you.
Thank you, Dr. Couchman, and welcome everyone to our session this evening, opportunities and pitfalls for starting out in private practice. Really pleased to be with RACS again. I know we presented back in June to some of the members, and it's great to be back with you again this evening. My name is Adam McCann, as Dr. Couchman just introduced me, and I'm one of the directors here at Barton's, and I'll be your MC for this evening. No doubt 2020 has been an interesting and a challenging year. I know that when we spoke with you back in June, we just seen the coming out of that period of a couple of months where all of the non-urgent elective surgeries had been cancelled. That's that period March through into May, and people were starting to return back to work again. And you know, at that time, we were aware there was a backlog of around about 400,000 cases. So no doubt you've all been very, very busy over the last couple of months since we've last been in touch with you. I think here in South Australia, we've been incredibly fortunate, and I know in reading the RACS newsletter over the last few days, obviously there's been real challenges for members in Victoria, but thankfully here in South Australia, things have been much more stable. You know, going into private practice, I think at any time is a significant transition, but particularly during a period like 2020 when we've seen such a really unusual period. So we're really pleased to be able to meet with you tonight and to just share some of our insights to really help make that transition that much easier. Now, just a little bit about Barton's before we kick off with our presenters. Barton's is a South Australian-based chartered accounting practice. We were established here in the South Australian market in 1965. We have over 55 years experience here in SA, and we have a team of around 50. We provide integrated services to a lot of small business owners, professionals, but we have a distinct specialisation in providing advice to medical professionals. It's very much around providing integrated advice, tax and accounting, financial planning, finance, risk insurance, and we also have relationships with lawyers to provide estate planning. So I think for you, we recognise more than anything as a medical professional, time is always the challenge. So we seek to provide an engaged and integrated service really just to try and lift that burden somewhat. More broadly, Barton's is the South Australian face of the Buongiorno National Network. The Buongiorno National Network is an affiliated group of chartered accounting and financial planning practices. We have a presence in every mainland capital across Australia. Each one of our practices has more than 50 years experience, other than Smith Coffee. They've only been around for 44 years. But across our network, we're currently providing advice to over 15,000 medical professionals. So that gives us real insights into the opportunities and challenges that you face as a medical professional. And we collaborate very much across that network so that we can bring cutting edge insights and financial planning and accounting techniques to you. The Bongiorno network has been working with RACs for many, many years. In 2018, we introduced the Bongiorno National Network Youngest Fellow Travel Grant. Now, I know in this year of 2020, there hasn't been as much travel, unfortunately, but we do look forward to sharing that with some of the younger fellows, hopefully in 2021. Now, in our last presentation, I used this next slide. I find that it does resonate, and you might wonder, what has a billiard table got to do with tax and accounting, financial planning, and more broadly, you know, how would that be useful for a younger fellow? But we find this is a very useful analogy in terms of the way we approach our advice. And I think as a surgeon, I'm sure you'd use the same approach. In a surgical analogy, you would always be thinking 2, 3, 4 steps in advance. In the accounting and the financial planning space, we seek to look at opportunities for today, but build in real longer term flexibility to maximise for your opportunities for the longer term. So as we go through the presentations, we'll come back to this analogy, but it's very much around building flexibilities so that you can really maximise your longer term opportunity. Now, tonight we have 2 excellent speakers. To kick off, we will have one of our chartered accountants, Matt Batchick. Matt has over 10 years experience in providing advice to medical professionals. He looks after the bulk of our medical clients here at Barton's on the tax and accounting side. But at a personal level, Matt's mother's a GP, so he has real life insights into what it is to be involved in the medical profession. We'll also have Steve Jenoff presenting as well this evening. Stephen and I have worked together for over 13 years. Steve's a certified financial planner, has a Bachelor of Commerce, but most importantly, he works exclusively with medical professionals. He's done a lot of work with our younger interns, but now is doing a significant amount of work with the younger fellows as they progress from being in that public environment to making the changes around in moving into the private sphere. Now, tonight will be interactive. If you've used a Zoom or you've been on Zoom, I think it's death by Zoom at the moment for most people, but we encourage you to use the chat. And as we go along, if you've got any questions, please share that in by using the chat bar, which is at the bottom of your screen. That will go through to Louis, who's showing there on the RACS Victoria screen. And at the end of the session, we'll spend about 10 or 15 minutes, hopefully answering all the questions that you might have. So without any further ado, it's my pleasure now to hand over to Matt to open up in terms of the tax and accounting side and to share some of the opportunities and pitfalls as you move from being in that public space to in private practice. So thank you, Matt.
Thanks for that introduction, Adam, and good evening to everyone out there. It's nice to be back presenting virtually to the RACS members again. On the back of our last presentation, we had some solid client outcomes, which was very, very pleasing to see. I guess amongst all the uncertainty that's happening in the world right now, I can say that COVID hasn't impacted the strategies that are being discussed today. The landscape for solid tax planning hasn't changed. So I guess we'll get straight into the mistakes or the opportunities. One of the common questions I hear is, how do I structure my practice? We find that there's a lot of water cooler talk around this question. Often clients will come into a meeting and say, oh, a colleague has structured his practice this way, or I've read an article in the paper about this certain structure. I guess first and foremost, as tax professionals, I guess we have to work within the guidelines set by the tax office. And the last thing we want to do is have a client have a structure that's incorrect and be investigated by the tax office. Hence why setting up the correct structure from the outset is so important. Unwinding or unraveling structures in real time is very stressful, it's time consuming, and it's really what we try to avoid at all costs. I'm briefly just going to explain some of the common structures that are out there that you may have heard of. And I guess, so in a meeting, a client may say, can I use a company to set up my private practice? The short answer is yes. However, over time, tax and superannuation legislation has changed significantly, and the benefits of operating under a company have eroded over time. There are also additional costs with using a company, such as asset registration fees, and these costs don't often translate to added value. So as a result, we're sort of finding that recommending a company to be used for private practice is less common. It's followed up by a second question as well, can I use a trust? Again, the answer is yes. However, there are some important personal services income implications to consider. Now, I do apologise for getting a little bit technical here on a Thursday night, but personal service income is an important concept to understand. As opposed to a business that sells products or delivers a service that's created by a team of employees, the income you generate as a health professional is your personal skill set. Now, the tax office is aware of this and have implemented a set of rules, basically personal service income rules, that prevent an individual, a high-earning individual like yourself, trying to shift funds to a lower-earning individual. So, again, for professionals like yourselves, this legislation ensures that any income you earn that is related to patient fees be taxed in accordance with you. So you can't really set up a trust and then try to distribute some money to family members. So as a result, we're finding that recommending a trust structure again creates additional complexities, and you don't get the added benefit. On a side note, I just do want to highlight though that trusts shouldn't be disregarded at all. They are an effective tool when used correctly. Often trusts will be implemented to hold investments where the income derived can be allocated to family members and where personal service income rules don't apply. So the important distinction there is the income is a result of an investment as opposed to a skill set of an individual. Now, the third option that's often discussed is a sole trader, and this structure is simpler, less costly, and also provides the same tax benefits. As a sole trader, you have access to the small business tax concessions, and in particular, the much talked about instant asset write-off. You can claim an amount for a purchase of medical equipment or a motor vehicle to the extent that it's used in your business. These concessions aren't limited just to companies and trusts. So a lot of people aren't aware of that. And furthermore, as a sole trader, you are eligible to contribute to superannuation, which is tax deductible, as well as employ staff for administrative duties. Now, I guess the structure of your private practice can change with time. We're aware that things don't stay stagnant. Whether you wish to expand, join with other practitioners, or if changes to tax legislation make your current structure inadequate, we are able to reconfigure your practice to best suit your needs. Using the billiard player analogy raised by Adam before, any changes should be implemented with correct tax planning, thinking ahead in order to avoid those nasty surprises that we talked about earlier. Now, the common mistake, second mistake that's a question that's often raised in client meetings is tax deadlines and lodgement dates. The ATO lodgement deadlines differ as your circumstances change. An individual who lodges a return themselves, whether that be salaried or in private practice, needs to do so by the end of October. However, if you use a registered tax agent like Barton's, you get the deadline pushed to the 15th of May the following year. So in essence, that gives you an extra 8 months where you don't need to lodge your tax return and pay any tax debts. So when you commence private practice, the tax office will only be notified that you've earned this untaxed income when you lodge that first tax return. And this is quite important because this provides a special opportunity that's only available when you first commence private practice. Often labelled the tax honeymoon, you have at your disposal essentially 22 months of untaxed income, which you can use to your benefit. Now, obviously the tax needs to be paid at some point. You can't just forget about it. However, deferring it does come with it considerable benefits. You can use that surplus cash in other ways that aren't just paying the tax man straight away. In our experience, we've found that doctors don't have an earning problem. They might, without offending anyone, have a spending problem. So we see clients who haven't planned appropriately, they spend the money, they do forget about the tax man, they see the large increase in income, they do get excited. So it's just being aware that with the appropriate tax planning, venturing into private practice brings with it significant benefits, but you just need to monitor your deadlines and your liabilities. Now, the third common mistake is how to structure your debt. So when it does come time to pay your tax, practitioners running their own business are treated differently to salary and wage earners like myself. You have the ability to borrow funds to pay your tax liability and claim the interest on that debt. So we like to use the analogy of cholesterol. So similar to cholesterol, we think of debt as being either good or bad. So you've got your HDL, your avocado, which in the tax world is your good tax deductible debt, or you've got your LDL, which is your McDonald's chips, which in the tax world is your non-deductible debt. Now, the long-term goal is to reduce all debt. However, deciding which debt to pay off first is also a pretty important factor to consider. The strategy that can be implemented that we implement is to use surplus cash to pay down your non-tax deductible debt and then borrow funds to pay off your tax debt with interest being deductible. Now, a lot of clients, when I sort of sit down and we talk through this strategy, ask, why would I do this? I guess the answer is that the two biggest expenses you have as a health professional are your tax liabilities and your debt repayments. So if you structure these in a tax-effective manner, they'll have considerable implications on your future wealth. In addition to the personal service income rules that I touched before, there aren't a lot of levers that you can pull to help reduce your tax and accelerate your financial position. So based on your tax rate, we often say to clients, when you turn up to work, you're working the first 2 hours, 2.5 hours for the tax man. What we want to do is try to reduce that to the first hour and a half. So that's why tilting the scales and changing the character of your debt is a valuable strategy to use. Lastly, I just want to touch base and just say with personal and business accounts, a lot of clients come in and say, how do I need to open new bank accounts? Is it all the same? We recommend that you separate the two. This just ensures your records are clean, which in turn makes your bookkeeping and your tax preparation much simpler and cost-efficient process. Also, with the development of cloud-based accounting, you can access the information real time. So if the information's clean, you can really get some good data on your business, how you're tracking, and it just makes the process a lot smoother. So that's it for my part. I'd like now to pass you on to Stephen. I'll be here for the Q&A, and I look forward to that. Thank you.
Thanks very much, Matt. Appreciate that. You got me a little bit hungry now. I feel like some McDonald's chips, but we'll soldier on for the time being. Yeah, that's right, Dr. Couchman, we won't do that. So number 4, in terms of common mistakes, it is common to see surgeons, just as they intend to start in private practice, thinking about buying property or upgrading a home. In theory, if private practice leads to higher earnings, a bank would normally look favourably at this and allow you to borrow more. However, during the transition from public to private, the majority of banks are not so willing to lend you these higher funds until they have seen 12 to 24 months track record of your private income. Future income can be so difficult to assess from a banking perspective. Therefore, you'll be wanting to think about your next property purchase either 6 to 12 months before your change to private practice, which could restrict your borrowing capacity, or 12 months after starting private practice. The part in between is where things get a little tricky. And to understand how you could be assessed differently during all these stages, you should meet with a lending expert who understands your situation, can show you the various options, and has access to a large panel of lenders. We do have a lot of queries around fixed rates versus variable rates for home loans at the moment. Before fixing any loans, you should consider your future plans, including any upgrade to a property. There can be significant costs involved for breaking fixed rate loans, while variable rates can create a more flexible structure, allow you to operate an offset account, and leave things open for the future. Perhaps a combination of fixed and variable is worth considering. On to the 5th most common mistake. It's relying on previous employers' super funds and other arrangements. Because if you've been in SA Health for a while, you would have heard from and received information about Super SA, including the benefits they provide while you are in the public system. But think of Super SA as a light switch. If you are doing some level of public work, the light is on. But as soon as you move to 100% private work, the light is off. And a lot of the benefits and strategies Super SA can offer is gone, potentially leaving you in the dark. Assuming you do begin working 100% private, you'll need to find a new home for your super funds and future super contributions. The other major difference between public and private super funds is the untaxed versus the transfer balance cap. Again, try not to get too technical tonight, but depending on which cap you are able to utilize, it's going to change your strategy in terms of how much you can contribute to super each year, how much can be in the super fund at retirement, whether you can set up a spouse account or not, and the tax treatment of contributions and growth along the way. Adding to this, any personal insurances held within Super SA should be carefully reviewed so that you are fully aware of what you are covered for and potentially what you are not covered for when you start private work. We often see doctors leaving SA Health and not having any personal income protection in place. This is a massive gamble that is just not worth taking. The public-private mix can change your strategy dramatically, so reviewing all of your super and personal insurance arrangements as you consider the move to private practice will protect your future plans and help grow your assets over the long term. We also have a lot of queries around retail versus industry super funds and what would work best for those moving into private practice. It can be different depending on how much value you place on the management of your super, the balance of your super fund, the way you wish to invest, whether it's actively or passively, and also whether you are making additional contributions. On to the sixth most common mistake. It is the expectation around automatic contributions to super to continue. If your work from public employment is reduced or is no longer in place, the only person who is going to contribute to super for you is you. There is a very unique strategy available to those still working some hours in the SA public sector, which is for another session. However, very quickly, what you could do there is take advantage of the untaxed nature of Super SA for contributions and accumulation. Think of your super contributions as a dripping tap, with a bucket as the total cap. The aim is to fill the bucket drip by drip from now until retirement without overflowing the bucket, as this can lead to unnecessary additional taxes and penalties. In other words, you could be exceeding the cap. But if you don't keep the tap dripping over the long term, you simply will not fill the bucket. Hence, there is tremendous value in a long-term super strategy where you fill the bucket not too quickly and not too slowly, not too late and not too soon. But who has the time to monitor these levels and check on the bucket all the time, let alone deal with the legislative changes and market movements along the way? Speaking with a financial advisor will allow you to have someone regularly manage your bucket, ensure your strategy is updated with any major changes in legislation, manage your level of investment risk, the balance of your super, and also ensure you are contributing the right amount each year. While the rights to private practice offers so many positives, you also need to be aware of the work-life swing. With potential for greater hours and higher earning rates, the sky is the limit. However, with family and personal commitments, as well as managing workloads and finances, it can often lead to a highly stressful time. If you're finding yourself time poor right now as is, imagine what it could look like for you in private practice. When you are in the operating room, you need surgical assistance to ensure you can deliver the best possible outcome for your patient, and you cannot do it alone. Many doctors tell us how surgery is a team environment. So when it comes to your finances, a financial assistant is there for you to help manage the ever-changing landscape around tax, investing, superannuation, insurance, estate planning, property purchasing, and the list goes on. Bartons are problem solvers. We're here to help you with all things financial, and most importantly, we want to keep the balance right for you and your family. So before we get into the Q&A, I wanted to let you guys know that we have prepared a private practice cheat sheet just for you. So if you would like a copy of this, all you need to do is send us an email at hello@bartons.com.au. Thank you.
Great, thanks Stephen, and thanks Matt. Some really useful insights there. I think we're covering a relatively comprehensive change for the younger fellows, and so if you've got any queries, you can go to Hello at Bartons. That checklist, the cheat sheet, is really useful. But we've now got the opportunity to jump into the Q&A. And I can see that earlier on Dr. Couchman put up a question there. So the initial one, I think this is directed to Matt. When would it be appropriate for use of trust for profit distributions, purely used for investment or distribution of business profits? So Matt, would you like to shed a bit of light on that for us?
Yeah, sure. And that's one of the questions that it does cause some confusion out there. It really depends on the nature of the income that you're talking about. So as mentioned in the slides, if the income derives from your personal skill set, being patient fees, that can't be distributed out to other family members. The ATO deems that to be personal services income. They say, your particular skill set, you've earned that money, that belongs to you. However, you can use a trust, for instance, say you bought into a private practice, you own an equitable stake in a private practice, and that's a business in itself. That may distribute profit shares to your trust. That's deemed to be an investment, and then you can distribute that money out to family members.
Thank you, Matt. Just a quick addition. Is so bad because I'm deviating from the rules.
No, that's all right.
Just with regard to distribution, do you want to just give us a little summary on who you can distribute to?
Sure, of course. Yeah, that's a very good question, because there are, like everything, there are a lot of rules and regulations around that. So with regards to children, unfortunately, from a tax point of view, they're not that beneficial to you until they reach the age of 18. You can distribute $416 per year in a tax manner. Once they reach 18, they are fully fledged adults in the eyes of the tax law, maybe not in any other aspect, but so then you can, at that point, and we often say to our clients, that's the only time they'll save you significant money. You can utilise if they're studying at university and they don't have any other income, you can distribute to them then. You can also distribute to other family members, parents. Obviously, the more people you bring into the net, it does complicate things in terms of it is a legal entitlement owing to them. So there are some legal sides of distributing to family members. So you need to consider other aspects, not just the tax and accounting side.
Matt, another question that's just come in privately, similar vein. I'd like my partner to be my bookkeeper and do admin. Does this change the structure that I go for?
No, so in all those three structures, you can employ staff, and that's what makes the sole trader, without having those additional costs, quite a favourable structure to run with. The important key there is that the amount that you pay has to be at market rates. Everything has to be at market rates, arm's length, what you'd pay someone out in the market to do your bookkeeping, then you could pay your spouse or partner or adult child or whoever it may be. There are also employer sort of obligations, so superannuation, and also potentially work cover and the like. So there are other aspects to consider when paying family members.
Okay, thanks, Matt. This is one more, I think, directed to Stephen. He was talking about Super SA and the light being on and the light being off. But there's one here: if I was working 50% public and private, will my income protection that's provided by Super SA protect my private earnings?
That's a great question. So in short, the answer is no. However, what should be noted with any Super SA policy is it will definitely cover your public income for income protection. It will also pay your superannuation of 9.5%. So your public is covered, and that is all well and good. The issue we have is that private earnings could be significantly higher than the public earnings. So we are then, putting ourselves in a pretty risky position if we're not covering that private part. And what we would suggest is looking at one of two strategies. One would be setting up a separate policy simply to cover private earnings. The other option would be to set up one policy that covers all income that you earn, being public and private, especially as we would tend to see that public hours will reduce year on year, which then leaves us with a significant level of private income.
Okay. There's another one here on borrowing, Stephen. It just said here, you mentioned that the majority of banks won't look at me for the 12 months after I start in private practice, but a colleague who recently started just upgraded his home. How does that work?
Yeah, another great question. So I made a bit of a note in that slide that most banks will not look at or entertain the potential for someone who's just moved into private within 12 months, and that doesn't cover all banks. So there are a couple of banks that we do work with, which is where it's really important when you are getting lending advice that the people you're speaking to have a large panel of lenders. They don't just work with a couple of banks, because sometimes, depending on the policy guidelines, there are some banks that can open things up. There might be some limitations, but we would definitely, with a large panel of lenders, we think we can find a solution. It's just that, going out on your own and going to each bank individually, where you might not be getting the right response, might make you think you can't get the borrowings. We feel like there probably might be something there, but it might be a bit limited.
Okay, so get some advice. Another tax-related one for Matt. Just a simple question, in terms of moving to private, when do I register for GST?
Sure. So I guess the legal requirement around that is once your gross earnings are 75,000 or more, so you need to estimate that, whether you believe that you'd hit that mark. Anything below that, you don't need to register for GST. However, for medical professionals, you're in that particular situation where the income you derive, that's GST exclusive because it's deemed to be an essential service. So you don't apply any GST to that, but you can claim GST on all your expenses, business-related expenses. So at the end of the year, it ends up with a positive refund in your name. So we do recommend in most situations that you do register for GST. There is a small admin side to it, but you do get the credits back, and just an added bit of bonus.
Okay, thanks, Matt. Another question on the super front. There was conversation about building wealth through super, but other than super, how can I build my wealth? Yes, there are definitely plenty of other ways that you can build wealth. The reason why we talk about super is because it's a long-term investment. You can't access it until you retire. It's there for the long term, and it's very tax effective. But it doesn't mean that you can't look at other ways to invest. There are plenty of surgeons that we see that look to build up their property portfolio. So they might have a family home, they're looking to purchase investment properties and so forth. The only thing again about that part is really just at what time of your transition are you looking to borrow funds, and that's where we can have a chat around that part of it. So property is a very popular area for building wealth, and we offer an analysis on where to buy, what's looking good in certain suburbs, whether it be locally or potentially interstate as well, rent yields and all those sorts of things. Another area would definitely be looking to invest outside of super in shares or managed funds. That's very attractive. We definitely wouldn't be jumping at some sort of investment vehicle like cryptocurrency. We wouldn't be jumping at something like that. We don't feel that's necessarily the best long-term strategy for most people. But when it comes to long-term investing, shares and managed funds can offer a lot of long-term growth benefits. Okay. Dr. Couchman, they're all the questions that we've had that have come through thus far. Do you have any other questions you'd like to ask us this evening?
No, I don't. I must say it has been excellent to listen to all of you, Adam McCann, Stephen Jenoff, and Matt Batchick. Thank you so very much for your time. It really does point out, I think, the importance of having a team that is varied in their skill set in helping assure the future plan, because you're a specialist in an area that is nothing to do with what you've just talked about, and you need the specialists in that area to support you to get where you want to get. So it's been very eye-opening and certainly very enlightening, and it certainly sounds like the attendees can access you for further information on what you've touched on as well. Is that correct? If they can.
That's correct. So we'll bring up the slide with the cheat sheet that we were talking about. It was hello@bartons.com.au. I do know we've just had one more question pop up. So this is from Dan. So can you please clarify regarding GST? Was it just said that a surgeon offers an essential service and hence are GST exempt? Do surgeons not pay GST? So a nice tax one there for Matt to round it out.
So that's correct. So if you are charging the client directly, that service is GST exempt, so you shouldn't be applying GST on that. There are variations of that. If you are assisting a surgeon, so then you're providing a service to a surgeon as opposed to the client direct. So that's not deemed to be an essential service because it's not a treatment. So yeah, there's different variations of it, but initially if you're providing that service direct to the client, that's GST free. If you're doing a report, that differs and that's inclusive of GST, so you need to apply GST on that. So as of everything, it's not clear cut in that regards, but yeah, patient fees for patients, GST exclusive.
Great, thanks, Matt. Now, I might just highlight there was a disclaimer that I didn't speak to earlier in the presentation, but I would note that the information that we've provided tonight is general in nature, and I'd encourage if you've got specific questions that relate to your personal situation, seek advice before acting on anything that we've shared with you this evening. Yeah, look, if you've got any specific questions, I'd be more than happy to assist you. So on behalf of the speakers, I'd just like to thank again Dr. Couchman for hosting us this evening, and also for Gail. She does a great job behind the scenes. So really appreciate your support there. You can see that little hand coming up. So it's been really great being able to be with you this evening, and feel free to reach out if you've got any further questions. Thank you.
Thank you, Adam. And look, thank you. And we hope to have you speak again, and hopefully perhaps in person and for a little bit longer than we have so far. And I just want to just remind the panelists and the attendees that this whole session has been videotaped and will be available for viewing on the Colleges Say website. And I suspect we'll get quite a few hits based on what we've talked about today. Look, thank you again and have a wonderful evening.
Thank you all. Good night.
Thank you.